discussion, Getting Capital into the Hands of Small Businesses. And our speaker is Jorge Sun, CEO of LendingFront. Welcome, Jorge.
Pleasure to be here. So just a little bit background on myself. So Jorge Sun, CEO of LendingFront. We are a pioneer and a leader in the SMB lending space, specifically also in payments lending technology. We've been doing this for over 6 years now. Just as a way of background, so you can understand sort of where we come from. So bankers by trade, American Express, JP Morgan. My co-founder and I were part of the founding team of On Deck. So really sort of pioneered the use of technology, new data sources to deliver capital to small businesses. And we built LendingFront to really help other sort of traditional financial institutions, deliver capital to small businesses efficiently. And the reason we did that is for those that have never been in lending, getting capital to small businesses is really difficult because the world of sort of lending views the world in two very simple segments. Either you're a consumer or you're a commercial entity. And small businesses, the ones we think are small businesses, sort of your mom and pop main streets, $1 to $2 million a year in revenue, 3 to 10 people, employees, tend to fall in what sort of a bank will call small commercial. The problem with that is that small commercial basically gets treated the same as sort of your large commercial entities, which means that banks default to the lowest denominator. So they don't really differentiate in terms of the way they treat a small business from a large business. The way lending happens today is it's essentially a banker-driven process. You have one banker that's assigned sort of the relationship, and they do all of the heavy lifting. Basically, they do all the lead generations, answer questions, collect documents, and the process for receiving capital is really quite onerous, especially if you're looking to borrow a small amount of money. And the way that we've seen now really sort of, sort of turning the model on its head and being able to become a much more efficient lender is by fundamentally understanding that you need a different technology infrastructure to lend to small businesses. Essentially, like I said, those that are under essentially 5 million in revenue, looking to borrow small amounts of money. And the keys to lending to small businesses is, one, you need to separate them away from sort of traditional commercial lending processes. Two, and this has really sort of come about even more now after COVID, is use their payment information to drive the credit underwriting process versus, let's say, dated financials, right? Large commercial entities will give banks financial statements, collateral to get a loan. Most small businesses are cash flow driven, so they don't have that. So they get excluded out of a lot of the approval processes. So the best way of doing it is using their payment information. And when we say payments, we're talking about their merchant receivables, the things that they batch out every day that gets put into their system. Think of any business that belongs to any platform, right? Whether you're a seller on Amazon or you're a restaurant that sells on Uber Eats, you're basically now generating a lot of payments, and you can use that to lend. And the other big component, and this is really comes down to efficiency. How do you get how do you acquire that loan and how do you deliver it? You have to use the small businesses payment gateways, right? Basically, the merchant processor they're using can be used as the acquisition channel, but also as the servicing engine, right? Basically, sort of skip the whole banker process and the commercial sort of like legacy, servicing platform. And the reason you want to do that is if you sort of use a banker as an acquisition channel and you use a legacy commercial LSP, Basically, you're subject to the same terms and conditions as a much larger loan, which, again, like we said, doesn't work for small businesses. The example I will put to you in terms of what I'm talking about is think of what Square is doing in Stripe, where they're using their actual payment gateway, right, their platform, as a way to acquire customers, determine underwriting, deliver the capital through that same platform, and then most importantly, collect it, right? They get in the way of the payment flow. What's also interesting is you would say, why are sort of these non-traditional lenders getting into the lending space? Well, they're getting into the lending space because, one, merchant processing is a commodity business. There's a lot of competitors. So you're always looking to increase revenue, right? Lending is great for customer stickiness, increasing customer relationships, and it's a natural extension, cross-sell opportunity. But what's most importantly is now lending is significantly easier to do. Before you had to, acquire a sort of commercial, level lending platform. Now that's no longer the case. Cloud computing has fundamentally changed that. And that's where we play, right? We sort of enable that white label lending technology process. So if you're a lender, you have the ability to capture the payments. We can turn you into a lender overnight. And we think that innovation is going to permeate throughout, sort of the banking industry, because there's some significant advantages. So if you think about, payments, the advantages that it has when you use it as a way to lend, especially in connection with the payments gateway, right? The actual device that the owner uses to sort of batch out their merchant payments every day, is the ability to really have a fast and convenience way to offer credit. And you can run pre-approval programs through that because you can see the payments every day. So you can actually invite a customer to apply, and basically use their history as a way to lend, which is significantly better than the current process that happens today. The current process today is, go into a branch, talk to a banker, send them documents, and hopefully they'll get back to you in 7 days. Sort of payments lending, best in class that we've seen is you can apply and you get your money the next day. It's actually one of the few true fully digital lending experiences where the applications, acceptance, and actual disbursements are all digital. You don't have to send any documents. Anything you need to sign is digitally. And one of the big benefits of using sort of payments information as a way to deliver capital to small businesses is that it's incredibly valuable. It's more valuable than a small business's financial statements or tax statements or even credit history. The reason being is all of that is point in time information, and it's also lagging. Looking at payments information on a daily basis gives you a true sense of how the business is doing. And leveraging that information means that you can make a better decision, a faster decision, a more accurate decision, which means you can deliver capital more efficiently to small businesses. And not using it means that you're trapped in a cycle of, sort of traditional commercial lending, which is not friendly to small businesses. Like I said, you can make decisions very quickly. Now, one of the most interesting aspects of using payments to control lending is the fact that as a merchant processor at that payments level, you control the flow of cash for that small business, which means that you can use that information to assess credit. And then you can use that information to determine how much you want to lend. But then most importantly, because you sit in between that payments flow, you can use that as a way to actually pay yourself back on a daily basis out of the percent of whatever they're batching, which means that you have full control over that payments flow, and you will get paid back first. Traditionally, usually the lender gets paid last. You can imagine a small business that has employees, that has a lot of bills at the end of the month, utilities, vendors. The last person to get paid or the last entity to get paid is the banker. But when you do sort of merchant receivables lending, that is no longer the case. Basically, now you can get paid every day before anyone else. And lastly, one of the biggest benefits is the fact that, cost of acquisition on these customers, especially if you're that payments gateway, is basically zero, right? It's not your core business, so you can like select who you want to lend to, and it's a natural cross sell. So it's a really efficient way to lend to small businesses, which is super important. So like I said, getting capital to small businesses really relies on adopting a new technology process, new technology stack that really leverages payments. Just to give you a sense of how significant that is, we sort of worked with a traditional lender when they moved over to sort of like a platform like ours, where they were able to now systematically put in pre-approval criteria, meaning they were scouring their information infrastructure or their payments data to qualify customers on a continuous basis. It meant that they could catch good customers up front. That led to basically almost 100% increase in the amount of loans that they could make. And it took the amount of time that it took them to actually take an application and fund from 14 days to 24 hours. So, if you want to deliver capital to small businesses more efficiently, you need to just understand that you have to fundamentally change the infrastructure and the data and the process to lend to them.